First speaker today, so I'm going to be talking all about growth metrics. So the numbers that you need to take a look at in your company if you want to grow, and the things that you need to focus on in order to actually move forwards. Who am I? Well, my name is Tim Rylatt. I run a company called UK Growth Coach. It's a business coaching firm. And I thought I'd just give you a 1 minute quick overview of who I am, just so you get a bit of context, and then I'll get into the main bits and pieces. So I've been a business coach actually for about 12 years. During that time, I've won a number of different awards, as have my clients. But the one that I suppose I'm most proud of is that for 5 years straight in the area of the UK I operate, I won the Best Client Results award. And that was very simply for growth metrics within the companies I was working for. So their profit, team numbers, things like that, things that demonstrate they were actually moving forwards. And that was really pleasing. It showed I was doing something right. I also think it's important to mention that I'm not just a business coach. I don't just talk the theory. I do actually get involved in the running of two marketing agencies. So I'm a commercial director in Growth by Design and the same in MJS Media. And that means that I have team, I have responsibilities, I have plans and budgets and money and all the rest of it to look after in exactly the same way as you do as business owners. So I genuinely do understand what it is like to run a business, as well as the concept of what that involves. And I just wanted to mention, over the past 10 years or so, I've written a couple of books. So Business Battleships is all around the psychology of why people buy, and Growing by Design is actually all about marketing strategy. I co-wrote that with our second speaker today, Henry Laker. He'll be talking much more on that aspect for today. In terms of my presentation, I'm going to be talking about KPIs, and I think most people in business would know that that stands for Key Performance Indicator. But what I've seen over the years is that there are an awful lot of people that actually understand the term, they measure bits and pieces, but sometimes they're not quite sure why they're measuring it. They've either been told to, or it's a historic thing that they've always measured, but they're not quite sure why. So let's just define what we mean by key in terms of performance indicators. Well, very simply, key is that they're changeable and that they matter. What I mean is there's no point measuring something you don't have any control over. It's very simply the purpose behind the metric is to now allow you to identify where you are against the progress target and make a decision on what activity is to drive that change. And the second thing is that they have to matter. If you're measuring things just for the sake of it, then what you're going to find is it's very boring, and you're also going to find it takes a lot of time and that your team aren't really enthused about it. And it's really important that you involve your team in that aspect. So measure with the purpose of protection. So put some metrics in place that actually allow you to see areas of risk. That could be how much money is in the savings pot, how much money do you owe, how much money is owed to you. It might be actually to do with the rate at which you're producing things, or the hours of your staff in working on a given project or task. Lots and lots of different things to measure, but some are defensive and some are actually target driven. So the defensive ones should be warning flags, things that ping up and tell you, yes, that's out of kilter. Here's approximately what your response should be, and because of the level it's out of kilter. Or here's the target you're aiming to, and this is how far along you are in progressing on that this week against this target, or this month against that target, and moving it forwards. So the three things to measure are: one is to make sure it's flagging an issue if there is one. The second is to flag an opportunity. So if you recognize, for example, you're only using 60% of the operating hours using or making your current offers, where else could you reuse that staff resource more efficiently? And maybe also to track performance against the individual goals. So when you're looking at KPIs, generally you'll want a set of numbers for finance, a set of numbers for people, a set of numbers for marketing, a set of numbers for sales, and so on, going through your business, whatever the main areas are, certainly ones for operations as well. In terms of growing your business, there are really 9 main areas that you need to be looking at in terms of KPIs, and they are falling under categories that I'm going to call the 9 levers. So if I say the objective is the improved profits down at the bottom, I'm going to reverse engineer this up. So if I want reverse profits, one of the ways I can do that is simply to do more of what I'm currently doing or earn more for what I'm currently doing. So either more of the same or more of the same with added value to it. And the drivers behind that are either a greater market share or something else. And then under the greater market share, there are three main areas of strategy. One is to grow your client base, and that's generally your marketing and sales processes. The second is to grow the lifetime value. So this is more your account handling and how you generate repeat or further sales or additional sales. And the third is actually to diversify your service range. Now, it's an important point here from a principle called Ansoff's matrix that too many companies try and diversify by selling new things to new audiences. It is actually quite risky to do that. The safest thing you can do is to sell more to the same audience that you've got. The next safest is to sell the same things you currently have, but to a different audience. And the third one, as I'll come on to the broader market penetration, is to actually sell current services to new audiences. So you're either selling something new to an existing audience, or you're selling your current services to a new audience, one set of new. The danger point is when you try and sell new products or services to a new audience. And just to give you an idea of the risk values, if you're looking at selling what you already have to an existing audience, the risk factor is 1. If you introduce one of the new elements, either a new audience or a new service, and the other part is consistent, then it's a risk factor of 4. And if you introduce new to new, the risk factor is 14, which will give you an idea as to why so many new businesses, which are coming out with new products to new audiences, tend to fail. So it's a really important part of your strategy to make sure you choose the right things to offer. Element number 5 is actually to develop value acceptance. And really what I mean by that is setting your pricing appropriately to make sure that you're getting recognition for the experience and skill set that you actually offer, or the quality of products that you offer. And the second part is how you present that value. So again, coming back to your marketing, but this time, not just the actions, but the way you present that message. The second way of improving your profits is actually to increase the margins. So that might be selling the same things to the same people, but just doing it more efficiently. And there are two ways of doing it. One is to just increase your focus on margins. And that might be to adjust the sales mix, maybe sell a higher proportion of the items that take you less time, cost you more money, and carry a higher margin. Another way of doing it is, if you're running at capacity, would be to trim out the elements that take a lot of time and don't earn you a lot of money, and replace it with other opportunity that you can't currently fulfill because you're serving those strugglers. And the final part in here comes down to improved efficiency. And really what I'm talking about here is cost efficiency. So the first part is taking a look at the service costs. This is cost of goods sold, the actual cost of sales, the fulfillment costs that you have in the company. And then the final one is just refining the standard overhead. So reducing your staffing if necessary, or overheads on buildings. Right at the moment, I think a lot of companies are now moving more to online models. So a lot of overheads are getting slashed in that. You can cover insurances, electricity, a whole wide range of other areas, but it's generally taking a look down the bill list and saying, when did I last negotiate that? Can I get a better deal? Is there something that actually I'm buying that I don't need every month? And by targeting all of those 9 areas of strategy, what happens is you improve your profits. So that's the areas of strategy and tactics that you can work within. And then there's actually the metrics that relate to it. So what I thought I'd do is just give you some examples of some metrics that fall within the sales and marketing, and a few others as we come down. And what I've done is put it just into a linear flow of how opportunity of value arrives into your company, and how it actually translates into money at the end of the day for you as a business owner. So down the left-hand side, what you can see is a straight line that it goes through. So you start out by generating some contacts and having some conversations, or sending information out to them. You've then got a static marketing conversion. There'll probably be a number of stages within that, but for the sake of today, just call it one conversion. And that generates you an actual inquiry, where someone says, can you please quote me, or how could you help me with that, and give you an opportunity to present something that they can either say yes or no to. Now, the yes or no proportion is what we're calling the sales conversion, and that will end up in clients. The number of clients you have multiplied by the amount they spend on each first transaction, multiplied by the frequency of that type of transaction happening, will give you your turnover. Your turnover times by your gross margin, so that's minus your cost of sales, cost of gross, cost of goods sold, will give you your gross profit. And from that, you're taking away your overheads to reach your pre-tax profit, or loosely your EBITDA figure. Just to show you how that might work, in this example, 2,000 times this company is actually putting its information in front of a prospect. 5% of the time that prospect is excited enough by that information or contact to say, yep, please quote me for that. The sales conversion on that quote is 50%, so you end up with 50 customers. Each of those 50 customers is actually buying £5,000 worth of value and doing it 4 times per year. So in this case, it might well be something like a manufacturing company that's selling a bulk set of electrical components or something like that. In other words, it's quite a high value sale each time, and the annual frequency is 4. That's £1 million in turnover. Gross margin's 40%, 400,000 profit. The overheads for running the business at that level are 200,000, leaving 200,000 to then pay the tax off and pay the directors. Coming a bit further on then, so what I'm looking at doing is saying, okay, which one of these things are the drivers? Well, all the ones in black on there are effectively the driver, and you'll notice there are 6 areas for that. And what I'm doing is just improving each one of these by a nominal 5% on that original figure. Now, every business will differ. Some will say I could do a lot more on leads, but I really couldn't touch my margin. Fine. Each business has its own metric, its own target it's looking forward in those things. But one thing's for sure, if you do grow the company, then the likelihood is at some point you're going to experience an increase in overheads. And for the sake of simplicity, I've just said in this example, I'm going to increase them by 10%. So here's what the results of those numbers are. And so 2,000, 5% up becomes 2,100, and so on for each line item. The 2,100 leads times by 5.25 now percent marketing gives you 110 inquiries rather than 100. And what you'll notice is it's 2 5% increases, and then it's a 10% on the inquiries. Another 5% on the sales conversion then leads to a 14% improvement in your actual clients. 5% on sales value, 5% on frequency. Now you're up to 25.7% improvement in turnover, and a final 5% on gross margin takes you up to 31.9% up. And in there you can see you're now making, in terms of gross profit, 527, nearly 528,000 versus an original 400. So 5% adjustments has added up to 31.9 because it's compounded running through. And with an overhead increase of 10% or 20,000, you can see that that company is now making another £108,000 roughly in pre-tax profit, or 53% up in profit. Now, most businesses, when you say, I'd like to help you improve your profit by 54%, will say, well, that's pretty hard going, or going to be pretty difficult, up until you say, do you think you could change 6 things by 5%? It really is the combination of small changes in the right places within the company that drives the profitability and success of that business. Hopefully that's been interesting to you. Now, one of the key challenges in making that happen is that you have to know the numbers. If you're going to track against how you're performing, you need to actually see how that's all coming together. And for that, you need your team to be reporting from their eyes on the ground what's actually happening in their area. But often there are 3 problems. When you say something, I need you to report a metric and I need you to report it to me in this format and at that time, lots will say, yes, fine. And then lots either won't do it or do it poorly or not recognize the value. And the reason being is that they don't understand the why behind it. So these 3 issues are actually what I call consequential. What I mean is the first one happens, which then causes the second one, which then causes the third. So these are the 3 issues. So the problem that I've mentioned already is that the team don't understand why. That's largely down to the owners, leaders, and managers just simply not taking the time to explain why they're asking for that number to be measured, the importance of it, and how it actually pays into the success of the company as a whole. The second part is that if the team don't understand the why, then they don't actually either associate importance to that task and say don't do it well or frequently enough. And then what happens is the managers go and chase it. They go and say, I haven't had that number. I better go and check with John what it is. They go down and speak to John. John says, I haven't measured it. The manager gets frustrated with the fact that he or she can't actually see that metric, and they know it really matters. And what actually now happens is you get the third challenge, which is because John didn't produce it before, then the manager then goes down and checks with John every 2 minutes to make sure that he's managing it in the future. which really isn't very fair, bearing in mind now that John understands the importance of why he should be measuring that metric and how to do it and why it matters to the company overall. He probably would do it without that micromanagement, and that just leads to resentment and loss of relationship inside the company. Now, all of those three challenges are interesting to address from a business owner perspective, is that often the relationships are a little bit soured. Often it's a matter of re-empowering the workforce and making sure that, you know, it's heading the right direction. And this book, Turn the Ship Around by David Marquet, is probably the best book I've read on changing the culture within a team, specifically towards performance metrics and actually reporting. And the reason it's so good is that it doesn't just focus on how to give the instruction, it actually all relates to how information flows within an organization. And just to give you an idea, it's called Turn the Ship Around because the guy that it revolves around is the commander on a United States nuclear submarine. In other words, somewhere where it really matters. And what they discovered was that his boat was performing substantially better than the others in the fleet, and they wanted to know what he was doing. And what they discovered was that largely what it came down to was the manager would actually give an instruction to the team members that he just wants them to report the following numbers. Here's why they matter. But I don't just want you to report the number. I also want you to tell me what your reaction to that number or information is. So the first thing is actually to report and share what the intention is. And then the manager can then make a decision. Is that intention that my team member is stating to me the correct response to that? And then they can either say, go ahead, which simplifies it and makes it very fast, or they can offer redirection and education to allow that team member to make a better direction on what they're going to do next and educate them on that. And likewise, the same thing happens between managers and directors or leaders up here, as in they report in their intention for the department they are in charge of. And again, the person at the one tier up can then respond that way. And it's a really efficient management model. And most importantly, it empowers the team. They feel they are accountable for the numbers. They feel that they actually can and should be making decisions about what they should be doing moving forwards. And it really works very, very well. The two words, I intend, from a team member are actually two of the favorite words I like to hear from my own team. So just to wrap that up for you from my side today, hopefully you found it interesting to cover off what some key metrics are, some strategies, and also how to engage your team with that. If you'd like to improve your business performance overall, I'm very simply offering a 90-minute business review to any of the attendees on this webinar today. And it's really easy. Just make a note of my email. It's tim@growthcoach.co.uk, or you can get hold of me on my mobile. I'm still working remotely from home at the moment, but it's 07735 414 185.